Hi, my name is Sandra Bailey. I'm the founder and owner of Women Financial Power. I'm also a business partner with Executive Strategies Group. Thank you so very much for being responsible and asking about life insurance. I've had so many people tell me that they want life insurance, but they just don't understand the process and the different types of life insurance. So today we're going to talk about 6 topics to help you make an educated, informed decision. We're going to talk about understanding the 2 types of life insurance and how they're used. What is your goal for getting life insurance? How much coverage do you need, or how much coverage do you want? What's the required information to get a quote? The underwriting process and the way the benefits are paid out. And lastly, completing the application. So let's get started. Now there's only 2 types of life insurance. There is temporary insurance for a specific time period, and there's permanent insurance that lasts forever, currently to age 121. The old policies used to expire at age 100, but people are living longer, so the insurance companies now have the policies expire at age 121. So let's look at the first one, term insurance, a specific period of time. So I've heard people say, well, I don't like my term insurance because it goes up every year. That's because you have an annual renewable term. So an annual renewable term, or an ART, is a 1-year term, and every year it goes up. If you're strapped for cash, it's the most inexpensive type of plan you can get, but you really want to convert that in 5 years. If you have it over 5 years, you end up paying too much, but it's the most inexpensive way to get started. So your term can start from 1 year and it can go up to 40 years. Now please be advised, if you're older, like 40 or 50, you cannot get a 40-year term. If you're younger, then you can get a 40-year term. The term expires, you no longer have coverage, okay? And there is a rider that goes on a term policy called return of premium. So some term policies, you can, at the end of your term, get all of your money back. That's pretty cool. And then finally, there's something called convertible terms. Now those are the term plans that I personally like. If you have a convertible term, that means within the conversion period, you can convert your term to a permanent plan without going through underwriting again. And we'll discuss underwriting later. So let's look at some reasons why a person would get a term policy. First, you have a mortgage. Say you have a 20 or 30-year mortgage. You may want a term to cover that mortgage. So if you pass away before the mortgage is paid up, your beneficiaries, your loved ones, can stay in their house and the mortgage will be paid off. Say you lost your job and you just don't have any money, but people are depending on you financially. So if something happened to you and you don't have that much cash, you may want to get a term policy. A business loan application. I've had clients come to me because they're trying to get a loan for their business. And if you have a term policy, that would be the amount of the loan for the period of the loan, then the lender will have be assured that they will get their money if you pass away through the life insurance policy. Now this family here is a very important one. If you have a family or you have young children in your family and you want to get a large amount of insurance in case something happened to you, the mortgage will be paid off, the cars will be paid off, you want to make sure your children get through college and be able to get their first job, you can get a large amount of term for least amount of money. So those are reasons you may want to get a term policy. Okay, let's talk about permanent insurance now. There's 2 types of permanent insurance. There's whole life and there's universal life. So your whole life policies is what we all been familiar with because our parents and grandparents got a whole life policy to cover their final expense. And we want to be very responsible and not set up GoFundMe accounts now, people, okay? We want to get some whole life insurance to cover final expenses. Whole life and universal life, some of these accumulate cash value. You can access the cash value through policy loans or withdrawals. Now, I do want to show you the differences in these policies. Some people ask, what's the difference between whole life and universal? Well, again, whole life, they have dividends, they build cash value, the companies have to put up more money in reserve, so your whole life plans will cost a little more. Your universal policies, there's 3 different types of universal policies. The first one is your guaranteed universal life plan. Now, your guaranteed universal life, you can get that plan for death benefit, and it'll be a little least expensive than a whole life, and it could last to age 121. Now, we're going to put a little monkey wrench in this guaranteed universal life, because what they did with a guaranteed universal life plan, it's guaranteed to last to age 121. However, some of the companies will allow you at certain term periods, yes, 20-year or the 25th year, if you want to, you can exercise your right to take your money back. So all the money you put in, you can take it back in 20-year or the 25th year. However, the difference between that and a term is if you decide you don't want to take your money back, you want to keep that policy because maybe you've had some health conditions, or you just know you want to keep it. You can't get any other insurance at that cost anymore because you're older. You can exercise your right to keep the policy in force. You do not have to let it expire. So that's the difference in the guaranteed universal life policy. Then you have an indexed universal life plan. Indexed universal life is used by a lot of executives and businesses to fund their retirement plan. You can do it with an indexed universal life, and you can do it with a whole life. A whole life has a set interest rate. An indexed universal life kind of goes with the stock market. The difference is it's not in the stock market. So when the stock market goes up, you make money in your indexed universal life. However, when the stock market goes down, the cash that you've accumulated stays flat. You never lose it. It just stays where it is. So that's the difference. With a variable universal life, the variable plans are in the stock market. So if the stock market goes up, you make money. The stock market goes down, you could lose money. I do not offer variable universal life plans. I only do safe money. If you're interested in a variable universal life, I have some members on the NAFR board, the National Association of Insurance and Financial Advisors, that I can refer you to. Now you'll see they say these policies will last forever as long as premiums paid. However, some of these policies, you can pay them up. You can pay the policies up and have them paid off in 10 years, 20, 30, up until age 65, and your policy will be paid off and you never have to pay for it again. Some of these retirement plans, you overfund it, meaning you put way more than what the insurance costs. So then when you retire, you can stop paying the premiums on the policy and you start getting money back to supplement your retirement. Now, I had to put this in with permanent insurance to let you know some of the uses that executives, high net worth individual, and Fortune 1000 companies, the way they use cash value life insurance. You can Google this topic, life insurance, a top funding vehicle in executive compensation plans. Or if you have a copy of the PowerPoint, you can click on it. It'll take you to the presentation. It'll take you to the article. This talks about how 73% of Fortune 1000 company executives use life insurance, permanent life insurance, to fund their retirement plans. They use plans like COLI's. COLI is a corporate-owned life insurance. Bank executives use BOLI's, bank-owned life insurance. But you can have a POLI, a personal-owned life insurance plan. This article is very interesting. You can Google Jim Harbaugh retirement plan, and these 2 articles will pop up, plus several more. Cash value life insurance makes Harbaugh college football's top paid coach, and how to use life insurance in your retirement planning. That's just awesome. I put this in here because I thought this was cool, the little black book of billionaire secrets. So these are the way high net worth people use life insurance, and you can use it the same way. So now, what's your goal? You got all these questions. What are my goals? My goal is to help you, a responsible person, make responsible decisions. And that's where we're getting started right now. So when you think about your goal and what we've talked about so far, do you have specific short-term goals or long-term goals? but they are for a specific period of time that we discussed. Do you have permanent goals? Do you want to build cash value? Do you want to leave a big legacy? You know, what goals do you have that are permanent? Now, there is some insurance called accidental death insurance, and I needed to put this in here because I do life insurance reviews, and I reviewed a plan and the person only had an accidental death plan. Now, accidental death insurance is only if you die in an accident. It could be a car, airplane, train, Uber, whatever. If you die in an accident, that's when this policy will pick up. So when you think about what your goal is, whatever it is, it's got to be affordable to you. Because again, this is a plan that you don't want to get and then cancel and start over. Because right now, you're as healthy as you're going to be. So you don't want to get it now when you're real healthy and then let it cancel. And then you have to start over again. Okay? So it must be affordable. So then the final question I get is, how much should I get, Sandra? Well, I don't know. Let's go through this dying. So think about a dying. So D is debt. So if you have debt, what kind of debt do you have that you want to get paid off when you pass away? And some people, I've heard people say, well, my family doesn't have to pay for my debt when I'm gone. Well, if they don't, then the bank or whoever is going to come repo your car, or your home may be foreclosed on. So think about the debt that you do not want repoed or foreclosed on when you pass away, because you want your family to keep that car or stay in that house. So you want to think about how much debt do you have. Income replacement. If something happened to you, how much income would you want your family to have? Because your family is already mourning your death. So basically, how much coverage do you want them to have? 10 times or 20 times your income. This is how much companies will allow you to get, 10 to 20 times your income. So your application will ask, how much is your income? Mortgage, we talked about mortgage. Expenses, do you want to just cover your final expenses? Or what other expenses do you have, like monthly expenses that come every day? Because your loved one, after you're gone, they may not be able to handle those expenses for a year. So maybe you want to cover those expenses for a few years. You know, education, your children going to college, you want to cover their college. So you would write all this down and add it up and see how much coverage that is. Now, there may be a lot. And so again, you have to look at what's affordable. If you can't afford all of that, then you may have to cut back and just say what's affordable. But this DIME method gives you a way to just establish how much coverage you need. Okay, now when we talk about how much coverage we need, the next thing is what I need in order to provide you with a very good quote. So name, gender, date of birth, the state you're in. Some people, that's all they want. But no, I need height, weight, tobacco. Based on your height and weight and whether you use tobacco or not is going to determine what rate and what company that I could use for you. There's no use in me getting you a quote without this information. Then finally, we have to have your health conditions, the medications, and your occupation. Now, when I say medications, medications that your doctor prescribed, not vitamins, not aspirins, nothing that is less is prescribed by your doctor. Occupation, I've never had an occupation that's been declined, but on the application, it will ask you a question. Are you a rock climber or different things like that? And so that's one thing we have to know. And if you're a student and you're not working, that's fine. You know, you're a student, but they just need to know. The underwriting process. Now, this part is very important. You can take notes and you can come back and ask questions if you want. But when you submit this information to me, I have to do preliminary underwriting before I send it to the company. Now, some agents I found out don't do preliminary underwriting, and you may end up getting a decline. My goal is to prevent you from getting a decline, because that will show up on your records when other insurance companies get ready to underwrite you. They'll see that you've already been declined. That's even a question on your application: have you been declined? So my goal is to prevent you from getting declined. So basically, once I gather all this information, then you can decide how you want to go. Now, fully underwriting is going to be the best quote, the most inexpensive quote you can get. If you're okay with getting fully underwriting, that's the way to go. They'll ask for a MIB. A MIB is your Medical Information Bureau report. That's just like your credit report. Anytime you go to the doctor, there's a record of it. So the companies will run an MIB report. RX is your prescription drug check. They'll know what prescriptions you got filled. Your motor vehicle report. If you're driving, they want to know if you've been in accidents. Then they may want a paramedical exam. A paramedical exam is when a nurse or a doctor, they may call to do part of your application, but they also may visit. You can go to their office or they can come to your home or office, and they will do blood, urine, physical measurements, height and weight. It's what they'll do, because maybe you have a policy that's for a lot of insurance, or high amount of insurance. It just depends on the company. But if you're okay with getting a free exam, fully underwritten would be a way to go. Now, your second type of process is simplified issue. Simplified issue means what the company will do, they may order these three, MIB, RX, and MBR, but they will not order a physical paramedical. They may call you and do a phone interview and ask you the same questions that I've already asked you in your application. They just want to make sure you're being truthful. All right? And lastly, you have near guaranteed or guaranteed issue. And to explain these two, near guaranteed issue is the application may ask you one question. Let me ask you one question, and that's it. If you answer no to that question, then the company will issue your policy. Guaranteed issue will ask you 0 health questions, and they will just issue the policy. Now, you hear about this on television all the time, that saying no one would be turned down, and no one is not turned down. The difference in this is the death benefit and how the death benefit is paid. So your fully underwritten and your simplified issue, some of these plans, well, not some, I'm sorry, the fully underwritten and the simplified issue are all level and immediate coverage. And what I mean by level and immediate coverage, once you're approved and your application is submitted and you're approved and you get a policy, you have coverage. So your death benefit or legacy benefit or face amount, you have coverage immediately. If you have a guaranteed issue policy or one that is near guaranteed that only asks one question, you will probably have to be graded or modified. Now, graded or modified is different based on the company. So what that means is a lot of companies, the first 2 years, if you pass away, you get your premium back plus interest, which is okay because you'll get up to 10% interest. Some companies don't pay to 3 or 4 years. I have a company that I really like. The first year you get your money back. The second year they'll give you half of your death benefit. And then the third year you get the whole death benefit. But again, keep in mind that's only for your guaranteed issue and some of your near guaranteed issue. Your simplified issue and fully underwritten policies will always be level immediate coverages. Okay? Now we're going to talk about optional. Now these are optional riders. You don't have to get these on your policy, but I do want to take a second and mention them. The first one is living benefits. Insurance is so innovative right now. They want you to be able to get insurance. They want you to love to get insurance. That's why they're making all this cash value, retirement plans and all that. But in addition to being able to use life insurance for retirement planning and vacation or whatever you want to use it for, there are living benefits. So what living benefits mean, say you have a $100,000 policy, and it could be a term policy or a permanent policy. Some of the terms include this as well. While you're living and you have a $100,000 death benefit and something happens to you, you can take a portion of that death benefit out while you're living if any of these things happen to you. Terminal illness, depending on the company, could mean the doctor say you're terminally ill, you have 12 months to 2 years to live. They don't know, but that's what they say. If they say that, you can get the money out of your policy and get your death benefit while you're living. Chronic illness is like long-term care. Chronic illness basically is what you do every day. There's 6 things. If you cannot do 2 of the 6 activities of daily living, that's considered chronic illness, and you can get money out of your policy while you're living to help pay for that. So let me tell you what the 6 activities of daily living are. When you wake up in the morning, if you're like me, sometimes you lay in the bed even though you know you got to get up and go to the bathroom. That's called continence. Continence is holding yourself and not using the bathroom on yourself. Then finally you get up and you run to the bathroom, and that's called toiletry. You go use the toilet. After you use the toilet, that's 2. After you use the toilet, then you go and take a shower. That's bathing. After you bathe, you dress yourself. Then you go downstairs and you feed yourself. And oh, the one I missed was getting out of bed, mobility. So if you can get out of bed on your own, mobile, that's number 6. So those things you do every day, if you cannot do 2 of those, that's considered chronic illness. The third living benefit is critical illness. That's stroke, cancer, heart attack. There are 5 major ones that most companies will include. Some companies even have about 13 critical illnesses, which is cool. So a lot of companies I use will include that, some won't. If you are an adult and you have children under age 17, most of the policies, you can add them to your policy, a child term rider. You can add a disability waiver of premium. If you become disabled and can't pay your premium, the company would pay it. Accidental death benefit, we talked about a separate policy for accidental death, which I really don't offer those. I can, but I don't like them. You can get accidental death added to your policies, and what that will do is increase your death benefit. Say if you had a 100,000 death benefit and you had an accidental death benefit on your policy, the rider, you may get 200,000 if you pass away in an accident. Then there's guarantee insurability rider, which allows you to increase your premium at certain ages without going through underwriting again. Okay, I hope this is picking up. So the last final thing is completing the application. So now that we've got all that information, I've submitted you a quote and you love the quote, and now you're ready to get an application completed. We can meet face-to-face, we can do it over the phone, we can do it via Zoom. There's so many ways to get the application done. It's electronically. Personally, I love electronic apps because I don't have to write it down, and you can sign it via your phone, your tablet, or the computer. First of all, I need a copy of your driver's license. That's because of the Terrorism Act. We have to see your driver's license. If we're doing it, completing the application via computer, you can text me a copy of your driver's license, or you can show it to me via the Zoom screen. You need to know who your beneficiary is. There's so many times that I'm completing the application and the person doesn't have their beneficiary's information. You need their full name, their date of birth, and their social security number. You will need your doctor's information. And some companies won't ask. Some companies will wait till the paramedical nurse call you. Some companies, I have to ask you. So have your doctor's information and the last time you visit them. And I don't need details. I just need to know this is Dr. Seuss, and you went to see Dr. Seuss on November 30th of 2019 because you did an annual checkup. And that's it. There'll be health questions on the application that I would just ask you, and the medications you took. And finally, what most people don't know is their net worth. The applications will ask you what your net worth is, and you just have to figure it out, what your net worth is. And finally, this is a consumer site, lifehappens.org, that you can go on to get any information that you want to get. Now this says, remember, you can't get life insurance once you need it. And basically it's like I've had people call me because their loved one was in a hospital. So if your loved one is in a hospital, then, you know, I can't write life insurance on them because the application will ask, you know, are you in a hospital or a nursing home or blah, blah, blah. And those policies will not most likely, they will be a graded policy that they have to live 2 years before the policy will pay. All right, and then some companies won't even write it at all if they're in a hospital. Okay, this is just a little review I put in here just so you can test your knowledge and see what type of policy that you really need. And finally, this is the end of the slide. For more information, this is how you can contact me. You can go to my website at www.womenfinancialpower.com and click on the Contact Us button, and you can set up a 15-minute strategy session. My email address is sandrab@womenfinancialpower.com. You can text me or call at 901-831-0965. Please leave a message if I don't answer. My business number, 901-617-1139. Please connect with me on LinkedIn. Sandra J. Bailey, LACP is my LinkedIn. Twitter and Instagram is at Sandra WFP. If you're on Facebook, please go to Facebook and like my Facebook page. It's Women Financial Power. And you will see that I have two sets of email addresses. I don't want to confuse you, but I work with independent agents. I use Sandra B at executivestrategiesllc.com. And when I'm working with my individual clients, I use Sandra B at womenfinancialpower.com. So if you have any questions, please contact me, and I'll be happy to answer any questions that you may have. Thank you so much for listening to the presentation.